Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So with that in mind, okay, let's look at this. This is an intraday chart. It doesn't matter, what time frame. Everything I'll be talking about today is applicable, that's a tongue twister, is usable in any time frame. Okay, so right around the 125 area with the dollar, notice what happened here. Doji, there's a market, and let me change the color here to make it a little easier to see in the background. Okay. Can you see the white arrow, Steve? I'm moving the arrow. No, you can't. Okay.
Not sure why.
Yeah. Okay. No big deal. No big deal. Let me see what I can do here. Let me try drawing. There we go. All right. Let me just fix this. Good. Okay. So. Okay. So when the market got to 125, for whatever reason, all right, the market stalled with the doji right at the same level. So as vibrant as the market may have looked on this tall white candle over here, we had a little bit of concern with the upper shadow, but not a very big upper shadow. This is the beauty of the candles, that within 1, 2, or 3 sessions, for example here, we're getting a sense that the immediately preceding trend is losing steam. All right. Now, of course, it doesn't mean the market's going to go from 125 to 122, in a few sessions. But what's really interesting about this is that we're getting the same lack of force. With the doji, the Japanese would say the market is tired. All right, and that's a great way of thinking about it. I mentioned before there's a lot of misuses with candles because doji are so easy to pick up. People see a doji and they immediately think it's time to sell short. That's not right. A doji means the trend goes from up to neutral. It doesn't mean it's going from up to down. But the fact that the trend is shifting from up to neutral increases the likelihood of the market turning. Of course, it's not going to be 100%. The Japanese have a great proverb, even monkeys fall from trees. Nothing is 100%. So the doji, especially the second one, confirming a resistance area by the first doji. A lot of really cool things you could do with doji. I'll talk at the end how to get some educational resources, some free, it's a good word, free, no-cost educational resources, because a lot of information, obviously, we won't have time to get into today, but you could use the high of the doji as a potential resistance area. So what you could have done is draw a line, okay, from the high of the doji, and I'm sure I won't be able to draw it straight. Okay, and that should become resistance. Now, it's okay for the market to get above the resistance area, but as long as it doesn't close above it. Okay, so over here. Try this again. I'm sure there's a way to draw a straight line, but that would be too easy. I like challenges. Okay, so now actually this is interesting because we have the doji as a resistance area here. All right, now notice how the market got above it. So if you were in an outright short position, that's one of the great things about Forex, by the way, a lot better than stocks, is that it's just as easy to sell short in Forex as it is easy to go long. And obviously with options, it's easy to do the short side from puts and so forth. But anyway, if this was an outright short position, you may have exited in that circle there, in that yellow circle at 125.40. But with the ability to have an option, you could withstand that and not be in too much price pain, because depending on the delta you have in your option, it may not be hurting you that much, although the market got above the resistance. And what that could have done is let you stay in the long put or whatever bearish trade you did, and then as the market starts going down, you could just leverage your short position. Once again, however, you're short in the option area, maybe be more aggressive on a put, something like that, add some out of the money. But once the market starts pulling back, you could just scale in, become more aggressive on your short option trade or long put, it depends how you look at it, and just ride it down. And this would have worked out really well, because you didn't have to worry, obviously, about time value decay too much if you were long an outright option, because it just happened so quickly. In fact, the volatility would have I'm assuming the volatility would have helped. Now, let's move on here. Okay. This is a section of a book I had translated. I had dozens of books translated from Japanese to English. And then the challenge was understanding the translations, because the Japanese do everything by metaphors and analogies, so it wasn't as easy as just having a book translated. I had to spend a lot of time, months and months, researching Japanese history, Japanese culture. I had to learn about samurai and all that, because the Candlestick information made a lot of references to Japanese historical information. But it was a challenge. I really enjoyed doing it. And it was great also because I was giving trading recommendations to the brokers when I was working at some of the brokerage firms when I was doing the research. And the more research I did, the better my trading recommendations became. So that really sparked my interest, kept my interest going to continue doing this research. Anyway.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.